Good morning, folks. Sorry for the delay there. We're getting started and yep, got a little bit of a feedback loop there. All right, so welcome to this week's edition of Back to the Futures with me, Markets and Mayhem. And apologize for the technical snafu there. Just had a few issues getting started up. But we are live now. We're going to get through these slides and dive into the market. I'm sure there's some interest in figuring out what all is going on in a market that has been pretty much straight down since Trump took office on account of increasing policy uncertainty. And that's something that we're not getting a lot of clarity on. So the volatility continues. So, first, before we dive in, I do want to let you know that the folks at Bookmap would love to have you join them on their Discord server. They've got a lot of great live educational events. You can do so by visiting discord.com/invite/bookmap or use the QR code on screen. And a little bit about me. I've been doing this for about 20 years. I love finance, economics, trading. I love building trading systems and analytical tools. In fact, I feel like one of our most valuable assets as traders is our mental capital. And the reason I say that is I see a lot of folks burn themselves out, not even blow up their accounts, but burn themselves out mentally, trying to do too much, trying to be aware of too many things, trying to do too much manual analysis in particular. And I would say this is an area where you can optimize by both tuning out noise and using tools that can improve your awareness of what's going on without having to do all that analysis by hand. Technology's come a long way from when I started 20 years ago, and I'm very happy about that because it's allowed me to really improve the tools that I use to, say, find pivots on charts and actionable options drive levels and order flow, as we're going to dive into today with Bookmap. So I think that one of the things that we can do as traders to really try to preserve our mental capital is to focus on what we find to be actionable signal, tune out a lot of the noise, and try to lean into technology where it can help us reduce the amount of mental capital we spend on our process. So we can focus on finding trades, executing, and really rinsing and repeating that process. And along the way, iteratively improving. What do I mean? So, first, if you're trading, you should be journaling your trades, both to hold yourself accountable, but also to keep a track record so you can go back and see what's working and what's not working. Once you figure out what is working and what decision basis you use to make your trades, you can start to do more and more to start to sort of automate your trading, right? And automate your input. You may not be at the point where you want to use an algo to make trading decisions for you, but you can potentially be at the point where you can use an algo to set up, say, alerts for certain types of price action or certain types of trading conditions being reached that you find to be more actionable than just staring at the screen all day, getting mentally exhausted and missing the trade because everything just starts blurring together after several hours of staring at the screen. The reason I say that is I feel like I know with the traders that I coach and with my own early experience learning how to trade that I didn't really have that appreciation for that other gauge, right? So I look at three big areas to preserve: mental capital, actual capital, and time. All right. And they have some interrelationship. But I also see time as a risk factor. Like the longer you're in a trade, and you would appreciate this if you're a day trader, especially, but swing traders as well, the more risk you may be taking, right? Time as a factor of exposure by its very nature of what can happen over longer periods of time is a risk factor to consider as well. So that's the other thing, especially in this more volatile market. Consider the time you're committing your capital to the market, your position size, and your stops, because in a market that's become more volatile, it's more likely that you're going to need to consider widening those same stops. It's just sort of how we've got to do business in this environment. If we come to appreciate that intraday ranges are going to be larger, you really need to look at widening those stops. And if you're widening those stops, you're increasing your risk level, right? You're increasing the amount that you may lose on a per trade basis, which then dictates that you need to size down. So instead of having the same amount of capital that you may allocate into a trade during a less volatile trading regime, now because in order to stay in the trade that you want to be in, you've got to widen your stops not to get kicked out. You should consider reducing your total capital exposure. These are all following along the same thesis of make sure you always have capital available the next day, the next week, the next month, the next year. Trading is a business. We're buying and selling inventory, and we're trying to be able to capture the spread repeatedly. That's our profit margin, that spread between where we bought and sold inventory or where we sold and bought inventory. And so contextualizing it in that term, rather than it being a path to quick riches and fancy cars, the reality is you're much more likely to be successful starting slow, being patient with yourself, pacing your goals, and scaling up your total exposure to the market over time, depending on prevalent trading conditions. And this is an environment right now where even more experienced traders tend to scale down so they can survive that sort of whipsaw environment. We'll go to a couple charts as to why we're in that whipsaw environment, but I do at least want to kind of share some of that wisdom in hopes of helping people avoid less ideal outcomes. I think a lot of people are going to get hurt if they haven't already been hurt this year by trying to size up, get cute, buy dips. And this market is not just bailing out dip buyers as it had in the past. This is a lot more like 2022, where the large stocks are leading us lower. And you'll notice that with the mega caps, whereas you see some of the other sectors and industries are actually doing okay. Low volatility, high dividend stocks are actually up on the year. Healthcare, consumer defensives, utilities, they're actually doing okay. But high beta, high growth tech, especially these mega caps and the riskier, unprofitable stocks, they're getting absolutely walloped. And this is a change of theme. This is a regime change, as it were. That matters because that affects how we set up our approach to the market. We really want to be longing things that are in favor, not trying to just sort of stubbornly go back to them because they used to work. These are not working right now. The narrative is changing. It's something I've been talking about on here for the last several sessions, that AI narrative is changing. And it's changing in a way where a lot of the growth projections have to be walked back, particularly to the pick and shovel sellers like NVIDIA, where if you're able to do 10 or 20 times more compute with the same hardware stack that you had with more efficient software inference and training, then you don't need as much compute, right? It also still is a question of when are we going to see a return on investment from a lot of the companies that bought all this hardware and have yet to create that sort of killer app, that high margin AI powered app that can scale. So investors are starting to lose their patience. And then we have tremendous uncertainty, to borrow the president's favorite word. But we have tremendous levels of uncertainty. This administration has successfully made volatility great again, which is exciting for us traders. But for the newer folks out there, and there's no shame in being newer at this game, everyone was new once. For the newer folks out there that aren't used to this type of a trading regime, you need to be willing to take a step back and approach it with humility, or you will be humbled by the market. That's the words of wisdom I want to pass on this morning to folks, because this is not the market of 2024 or 2023. This is something a bit different. And the rotation that's happening suggests there are larger institutional desks seeking the safety of bonds, seeking the safety of defensive stocks, even seeking the safety of the shiny yellow rock gold, which I am still bullish of to 3,000 here. But these are signs that there's a risk off theme. So let's talk about order flow, because that's what this stream is really all about. And if you all have questions while we're on the stream here, feel free to put them in the chat. And I will get to them as we get a little bit later in the stream. But I wanted to talk a little bit about why I watch order flow, because I think this is an area that it sort of has a lot of confusion. There's a lot of ambiguity about what order flow is and isn't on financial social media. And I'm very specific about what I feel order flow really is. It's both the flow of orders in futures and stocks, but also in options. It's all of that mechanical institutional flow, that retail trader and investor flow, and then how it's impacting price discovery in the underlying markets. I like watching order flow in the S&P 500 index options and futures because this is the heart of the US stock market. The S&P 500 is really the key index. And the options market for the S&P 500 trades about 1.2 trillion of notional every day, with about 57% of that volume expiring the same day. That's 0 DTE. And about 75% of that volume expiring the same day up to a week, right? So 7 days or less to expiration. That means most options trading is short-term driven. So that means for us as traders, when we're trading the futures, and S&P 500 futures trade about 350, 400 billion notional a day, this is the tail that wags the dog. We have to watch options positioning and flow, and not just 0 DTE, not just 1 week out. I would argue that it's the full chain that matters. It's the entire S&P 500 chain, and also the futures market itself. While most of that options order flow is hedged through S&P futures, so it's a huge influence of price discovery, there's also a whole slew of independent flows that go through S&P futures directly. Traders, institutions, retail participate in S&P 500 futures both as a hedging instrument and a speculative instrument. So we, as watching the S&P 500 as traders, we're able to glean insights about the pulse of the entire US stock market. That's pretty cool. It's also really helpful for determining turning points, trends, where we may see other beneficiaries, because a lot of it starts and ends with that S&P 500 stock, options, and futures feedback loop. So for me, the three areas that we'll focus on are going to be watching for differentials, or what we call deltas. So this term gets thrown out a lot. I'm going to be very specific with how I use it today. For the context of today's stream, when we're talking about deltas, we're really going to be talking about a few areas. One of them is the session volume profile. So on Bookmap on the right-hand side, and we'll go through this when I put the chart on screen. So this will be the quick version, and then I'll go through in more detail when we have Bookmap on screen. But on the session volume profile, you can see the deltas between buyers and sellers and where there are price levels where a particular party is becoming more aggressive. Now, if they get more in the money on their trades, let's say we're inferring that there's a big buy delta, and that means that most of the folks that are there are buying S&P exposure. The further we get above that buy delta, the more in the money those traders get, the more likely they are that they may add to those positions, that momentum may favor them becoming a little bit more emboldened in that trade. But the opposite can happen too. What if that big buy delta happens and then price goes down, and many of those folks that we infer to be long trades are actually on the wrong side of those trades, and more as time goes on, and they get further away from their entry price? Well, then they become motivated sellers, right? And they're more motivated than shorts because they don't have a choice. A short is still somewhat systematic or discretionary. There's some level of decision-making involved. But at a certain point, if you're long and the market goes against you, or if you're short and the market goes against you, you have to take the other side of the trade. So the longs have to sell, or the shorts have to buy back. So that's why I call them motivated, right? So you look at those session volume profile deltas, and you can start to find where one side may be getting offsides and how that could impact the tape. That's one form of delta. The other is the bubbles that you see a little bit, in the presentation. And again, when we dive in Bookmap, we'll go into this a little more, but those are delta bubbles. They're showing you which side is potentially the aggressor at any given moment in time. So the session volume profile is showing you deltas on the basis of price primarily throughout the session. And then the bubbles are showing you delta as a factor of time and price at that specific moment. So they're both useful. The bubbles can give you a little bit more of a feel as to where that aggression is coming in at a specific moment in time. And then looking for large passive order flow or icebergs, I find this to be quite important. This is something that the MBO data package in Bookmap data and Rhythmic allows you to see. And in essence, what you're seeing is large trading desks trying to hide the total size of their order. An iceberg is a sort of stealth order. right? So if you're playing poker, you don't want necessarily your opponents to know what your hand is. That's sort of what an iceberg is. So if you have 10,000 contracts of S&P to move, you might break them out to 500 lots, right? And you might put those into 2,500 lots. So you've got 20 lots, 500 each, and the reason you're hiding their total size is to make sure that the order book doesn't react too much to your limit orders. But there is a disadvantage to an iceberg, and that is as soon as your order executes, you're kicked to the back of the queue, right? So that means that you have a little bit more potential to not get the kind of fills you want, but you're trying to balance that out with how is this going to impact the order book? Obviously, if you come on the S&P 500 order book with a 10,000 offer, that's going to scare a lot of buyers away. So you might get less ideal fills with that just pure transparent limit order than you would with an iceberg. And big icebergs tend to mark turning points, especially when they're married with an exhaustive stop run on the other side. So if you see an exhaustive buy stop run, shorts are getting clobbered, getting pushed out of their positions again. They don't have a choice. They become motivated buyers. On the other side of that, if you see large layered sell orders coming in on the icebergs, that can mark a turning point. You could see the market start to reverse lower. And so that's why watching this order flow can be really helpful to find those confluent events. And exhaustive trading action when one party gets off sides. We talked a little bit about that with the stop run, but I've also built an exhaustion indicator in Bookmap that helps to find those exhaustion events as well. And so when one of those events happens, a little icon gets put on screen, and that gives me the sense that, hey, maybe I should be watching for a potential reversal here off one party getting a little ahead of themselves, right? Just kind of going way too aggressive in the book. Now, speaking of books, why do I use Bookmap? Well, one thing about Bookmap that I really like is the ability to put so much into one chart. Not only the data that we've just talked about, but you can layer in your own data. There's a marketplace with different add-ons. There's the add-ons that I built that I sell directly or are exclusively available via TraderAid. And there's the ability for you to map your own data on with things like Cloud Notes. In essence, you can have Bookmap be your primary charting system for intraday, and then zoom out with a different charting platform like TrendSpider or MotiveWave to watch those instruments in longer time frames and to add different kinds of analysis. To me, that's been a game changer. It's been extraordinarily helpful. It's also allowed me to downsize the amount of charts I'm looking at. I'm really looking at Bookmap for intraday, and again, MotiveWave or TrendSpider, depending on whether it's futures or stocks, for those longer time frame charts. And so putting all that together, for me, it ends up being a really indispensable platform. I like using Bookmap not only for watching the market, but also for creating those actionable alerts. So when I see a really large iceberg order, stop run, exhaustion event, aggressive absorption, or a number of other types of trading events, I also generate audio alerts for myself. This is part of preserving my mental capital, going back to that theme we talked about in the opening of this. The idea is if I have an alert that tells me when one of these events is happening, I don't necessarily need to be staring at the screen the entire time. I can be off writing code. I can be off doing research on swing trades. I can be doing, any number of other tasks. And then when that alert fires off, I can then check and see, is this a setup I want to trade? Preserving mental capital is your friend. So wherever you can do it and it doesn't compromise your process, but instead enhances it, consider it step by step. Now, getting into today's market, and we're opening up in just about 2 minutes here. Today's pivot that I'm looking at is ES 5641.75. Got a little bit ahead of myself there. Today's pivot 5641.75. So that means I'm more inclined to be bullish above and bearish below this level. And I'm just putting this out there on social so other folks can find it. And then some options analysis. We are deep in negative gamma yet again. This was actually last week's slide headline. I kept it on there because we're even deeper now. We're about 350 points into negative gamma. So we're close to peak negative gamma, which we'd reach around 5,400. You can kind of see that on the chart here versus the impact. Why does this matter to our trading? It comes back to the theme we talked about a little earlier. We're in a more volatile trading regime. And we can see that with the tape, but another way to know that we're getting into a more volatile trading regime without even looking at the charts of price action is to look at the gamma exposure level. Options play such a influential role in price discovery of the S&P 500 that knowing whether we're in positive, neutral, or negative gamma can also help us to determine the appropriate sizing for our trades. That is to say, the deeper into negative gamma we go, the less likely I want to be going big long or big short, right? That order book, that imbalance that negative gamma can create, combined with lower levels of liquidity being a feature in the flow, tells you that you can have more whipsaws pushing longs and shorts out of their trades. This is why I believe it's a good environment to widen stops to avoid getting pushed out if you're on the right side of the trade. And it takes smaller size so that if you do have to realize that loss, it's not game changing for your portfolio. Now, let's take a moment and just look at the S&P 500 options here as well. We can see 5,600 is a really, really big level going into today's tape. I think that's something that we're going to want to pay attention to. Really, this area, this range between 5,500 and 5,600. That's an area that we were kind of ping-ponging in yesterday and overnight. Now, ahead of today's market, overnight gains have been reversed. We were up overnight. We're now cash implied. The open now has just happened, so it's not cash implied. It is cash. It's 5606. We're down about 0.15% on the S&P 500. That's not a great look after a close like yesterday and after a trading day like yesterday. I don't really think we're out of the woods quite yet. We'll talk about that a little more on the charts. For folks that want to get a great deal on Bookmap and save this for later in case you want to see it before you try it, bookmark traderaid.com/bookmap to get up to 40% off. Just scroll down to the special offers at the bottom. If you'd like to learn more about my work and check out what we're doing at TraderAid, you can get up to 20% off using the code Mayhem20 at checkout at traderaid.com. Now let's dive right in to Bookmap here. So we have Bookmap on screen. Right now I've got Amazon. We're going to just go into the S&P 500 futures off the open. I'm just going to drag the filtered view a little bit further over here. And so we could see right off the open, seeing a bit of selling pressure. We're going to zoom out just so we can see that overnight session. So basically, you could see we had a little bit of a pop. Really, the bigger pop happened. Let's see if we could pull this back a little bit more. Let's do a 24-hour backfill here, just because I want to show the extent of the pop that we saw. And we are seeing some seller exhaustion here, just a little bit on that print. Doesn't mean it's super actionable because it's early in the tape. This is where a lot of institutional flow comes through. So a little more cautious inferring that to be actionable early. But what we saw before the market opened here, a big seller absorption of buyer events, 500 contracts, and that did lead to this sort of topping out and rolling over. So now that we've, let's see, have we pulled that all the way back? No, it does not seem that we have. I'm just going to pull up a different chart to show the overnight real quick in the interest of time. I know everyone's time is indeed quite valuable here. So this is a chart from my swing trade levels that I have set up, and it shows a lot of the options exposure levels as well. But basically you could see last night we had this push up to key 3 negative, right? And that's a level that is an options implied negative gamma level. And it ended up being a resistance that did put the cap on yesterday's move, that overnight move, even into this morning. So the reason I'm bringing that up is these options implied levels and these pivots, when you put them together, you get a really good framework of actionable levels to work off of. But it also shows you just how much higher we were last night into today's tape. So now this morning, we're seeing that selling pressure pushing us below key 2 negative. That's another level. Again, that negative gamma exposure level. This is more where puts are heavy on the chain. These tend to be a bit supportive. So you do see a little bit of buying coming in here. You also see a somewhat of just a smaller stop run happening right into this. But again, the morning tape, that first half hour to hour of trading, there's large institutional flow coming through. So be cautious until we really get a sense as to what the prevailing trend is, if it's going to be a trend day. I like to look at the first 20 minutes of tape to get a sense as to what the range is and what the trend may be. But very clearly, right off the bat, there is intense selling pressure in the S&P 500. And that was a 392 contract stop run that played out just about 5 minutes after the open. So again, markets are under pressure. We do have jolts coming up also at 10 a.m. So that is something else to keep in the back of our minds, because that jolts data, that can be a market moving event. So right now, just previewing jolts, the consensus is for 7.63 million. The forecast is for 7.5 million. The prior reading was 7.6 million, which was a miss. And so we are looking for another miss today. I would, if we want to be bullish of this market and we're looking for a turnaround here, and the NASDAQ is a bit oversold, I'd want to see jolts coming in at 7.3 million or lower, because that's going to build the case for Fed cuts. That's going to give the market some sense of calm that even though it's not getting what it wants from the government, maybe it'll get what it wants from the Fed. And that could lead to a bit of a turnaround. We do see buyers coming back in here after that opening sell as well. Now, this is options expiration. We're coming into that this week. I'm sorry, we're coming into that next week, but we're closing in on options expiration. And so that's another area where you start to see passive flows intensify in the first and last hour of the trading day, especially later this week and going into early next week. You have some of these supportive Vanna flows in particular. And I believe that's part of what we're seeing, because we have a very put heavy option chain in the S&P 500 right now. And that tends to give you additional flow. Basically, if the chain has a lot more put exposure than call exposure, which it does, then when those puts decay, market makers that have sold them, that want to hedge to be delta neutral so they have no exposure, they get to remove some of those hedges as those puts lose value over time. So that's something to keep an eye on in this opening, right? This sort of violent reversal we're seeing. Some of this is driven by passive decay flows in S&P 500 options. Just pushing above key 5 negative here on this move. We're going to check the NASDAQ here as well. NASDAQ having a nice pop here. Seeing a bit of an exhaustive stop run on that last move higher, however. And we do see sellers getting a little bit more aggressive on NASDAQ here. That was an aggressive absorption event. Again, first half hour of tape, not quite as actionable for those readings, but it does give us at least a sense that there was an attempt to try to stall out some of that buying that's coming in. Just like earlier, we saw an aggressive buyer absorption that marked that low as we took off in the NASDAQ. Let's take a look at some of these mega cap stocks as well. So Amazon right off the gate, getting a good bid here. Broadcom pretty flat off the open. And let's make sure we're getting those deltas in here. So we can see there's still a lot of overhead supply on Broadcom and on Amazon. Just a delta of about over 1 million on each. Apple in today's tape, similar look, just a lot of excess in supply. A bit of a bounce, though, off the open. Initially sold and then just trying to climb and now consolidating. Alphabet getting a bit of a pop off the open. Decent sell delta, but not quite as large as some of these others in terms of overhead supply. Looking at the banks, JP Morgan selling off on the open. Financials under a little bit of pressure here. Meta climbing off the open here, really defending that $600 level in today's tape so far. And pushing to new highs here, really Meta looking the best of all the Mag 7 I've looked at so far. Microsoft getting a bit of a pop off the open, pretty decent supply delta on this one as well, though, so that could impose resistance. And what I mean is that the order book has so much more on the offer side than the bid side. MicroStrategy, pretty flat. This thing has just been absolutely clobbered from its highs. It was supposed to give leveraged exposure to Bitcoin, but really it's just giving leveraged exposure to risk. I would be very careful. If one's bullish at Bitcoin, buy Bitcoin. I'm bullish at Bitcoin if we're getting back to 70 to 72K. That's where I think one could start to nibble a bit, but not here, and I wouldn't use MicroStrategy as a proxy. And NVIDIA getting a bit of a bid off the open here. Huge amount of supply overhead. And we could see that the big interest level it's going to be about $100. There's a million on bid NVIDIA at 100, 19 million delta of supply versus demand. So looking like a lot of the big tech, there's still a lot of folks that want to try to get out, particularly at some of these higher levels if they can. And then there is Tesla. Tesla, the president promising to buy a Tesla and offering his support to Elon Musk after the company's shares were slammed down 15% yesterday. And several large funds, a European pension fund and Dan Loeb's Third Point, exiting Tesla completely. So this company has been under pressure. I believe it's down over 50% from its highs. And just something to watch because, again, this is a really high beta trading vehicle. Whether you love or hate the stock, eventually it's going to have a turning point and it'll be a decent long. Whether that's here and now, that remains to be seen. I think it could still have some pain ahead, but at some point it'll at least be worth a trade. Now, let me just take a look around and see what we have in terms of any questions. Can you tell me your thoughts on a Bitcoin short today? So let me see if I have the contract up. I think I'm going to have to add it. Give me a sec. I think that it definitely has some potential to move lower, but I don't know that I would be super aggressive here and now. see if that brings us back. Yeah, that should bring back the Bitcoin contract wherever I've stashed it. There it is. So I'm going to give you the two-part view. I like to do this on any chart request because for stuff like this, we've got to kind of All right, sorry about that, folks on Discord. It does look like I was off there for a bit. Should be okay now, and my apologies for that. Had a bit of a technical snafu this morning, so just sorting all those loose ends out. Bitcoin, here's its proxy on screen, MicroStrategy, but let's look at Bitcoin. If it pulls up in the search here. There we go. And this has been my chart with this price target for quite a while. Whereas I felt like this was a very large supply zone overhead. And as soon as we started to cut below it, I shared that I felt that the risk to the downside had grown materially more pronounced. And so we are now getting closer to a level where I'd say maybe it's time to start longing this between 70 and 72K when we start to get back into this demand zone I've marked. But until then, I do think that the path of least resistance is likely to be a sideways to lower chop. I think the bigger chunk of the move is over with. That really kind of disorderly deleveraging we saw in Bitcoin. So I wouldn't be as aggressive trying to short it here without another catalyst. But I do think that the path of least resistance on a swing basis is still lower by about 10,000. So in terms of fading it today, let's take a look at the contract here. So overnight, pretty volatile overall. Seems like it had a bid, kind of got stuck in a consolidation range, and then got faded lower. Got a nice little pop here. Now it's getting faded again. So for your idea of shorting it intraday, it seems like it would be a worthwhile scalp trade. I wouldn't want to be shorting it for very long because of how high beta this is and how I've talked about time being a factor of risk management as well. But I think for a quick scalp, yeah, you could probably get this thing down to like 80,500 or so, you know, kind of have it retesting its lows. Let's zoom in just a little bit more on that chart. So it does have that heavy look, right? This is what I like to look for in the microstructure, lower highs and lower lows. Very much has that sort of a look to it. So it might be looking to put in another lower high here, and that might be the point to reoffer. So Rando asked, do I use Pine Script for strategies or something else? So I'm just going to say that I love TradingView's charts. I'm not a huge fan of their data. The data is not always as accurate as I need it to be to have the confidence level of executing off of it that I would want. So I use Python and I use data sources like Rhythmic, like CME, like CBOE to be able to make sure that the data that I'm processing is as accurate as it can be. So for example, for my SPX options visualizer, that's all written in Python. And that's about 1,500 lines of code that I engineered myself. And I actually made some huge improvements on it recently. So it's going to soon be available for just about any optionable instrument, which is really exciting, honestly. You can see some of the levels that the options visualizer has pulled in here. We've got hot call coming in now. That's the most active strike up here, just above 5,700. So you can see there is some options implied demand for higher prices on the S&P. This will flesh out as the trading session goes on and we start to see more of that flow. But in essence, I think Python is the best language for, folks that really want to get more serious about automation and taking a systematic approach. A, because it's not too hard to pick up. B, because a lot of the libraries that you would want for trading to be able to, pull from different APIs, to be able to process data, to be able to visualize it, to be able to automate and link into various brokers like Interactive Brokers and otherwise, it's all there. You don't have to reinvent the wheel. So much of the work is already done. So instead of putting everything on a single trading platform, like TradingView, which again, their charts are awesome. It's just the data that sometimes has inaccuracies in the indices and in the ETFs in particular. And so I can't really rely on that for like making a back-tested trading strategy if the data has variances that may cause the strategy not to work properly. But when you start to look at, your own curated data sets from reputable providers and then building your own code base or even using some of the existing code bases that are out there, there are existing code bases for backtesting with Python, for algo trading with Python, for, a lot of the things that we're talking about here that you can iterate and improve upon to kind of use it for your own process. So that's what I would recommend. I've been kind of at the intersection of tech and finance for long enough that I do have coding skills and I enjoy coding. I actually spent a couple hours coding last night just for fun, just to build upon this options engine that the SPX options visualizer uses to find the most actionable levels in the S&P options chain. So what you're seeing on screen is a result of that latest iteration that I built in the SPX options visualizer, right? And it's pretty cool stuff. But I would say that for doing your own strategies, you could start with something like PineScript, full well realizing the limitations of it and using that as just sort of like a learning tool. But if you want to get serious, I think it's all about Python. We are just about short of 9 minutes away from JOLTS coming in. Again, preview for that, 7.63 is the consensus, 7.63 million. The forecast is 7.5 million. Prior reading was 7.6 million, which was a miss. Looking for another miss today. If we get 7.3 or lower, I think this market could get a nice chunky bid. And that would be on the basis of the market looking for the Fed to intervene with lower rates. So if we see that JOLTS come in at 7.3 or lower, I think the long end gets a bid, and I think risk assets get a bid, and I think Fed funds futures price in a higher probability of a cut coming sooner than later. So just something to take into consideration as we get closer to that JOLTS data. Another thing for folks that are trading this market, please be mindful that just about 3 to 5 minutes ahead of these events, liquidity dries up. You're going to see it in the heat map. You're going to see the heat map become darker. That means there's less liquidity on the order book. Why is that important? Because if you're trying to trade that event and liquidity is drying up, your ability to get good fills is reduced and the likelihood of whipsaw price action is increased. So it's often best to let the reaction to the event settle a bit, look for the liquidity to come back to the order book before really trying to trade it too aggressively, particularly for folks that are trying to intraday trade. So one of the members of the chat room, Matt K, is saying, if I try to write in the chat more than once in 5 minutes, it won't let me. This is a restriction that the Bookmap team has put on the YouTube channel to try to encourage folks to join their Discord. And the link to the Discord is up top. But I would think it would be better to increase that threshold a bit so more people can participate. So just my 2 cents on that. But Matt, if you're trying to be a little more active, join us on the Bookmap Discord, and you can feel free to participate at the frequency of your choice. And just a bit of a sideways chop here as we approach that JOLTS data. Let's take a quick look at gold. Nice overnight session for gold, really pushing all throughout the European session, getting a bit of a blip, but making a higher low and then pushing higher as we approach JOLTS data. A nice 496 passive iceberg buy on gold as well. That's sizable for a contract that has less than 8K order book depth. So definitely liking gold. Still think it's on track for $3,000 an ounce, but the consolidation we've seen is healthy. That's what you want to see in a bull market. You don't want to see something going straight up. Things that go straight up tend to go straight down, right? So you really want to see a more of a stair stepping higher over time. That, in my opinion, is much more constructive price action. And if you look back at prior precious metals bull markets, you'll see that every parabolic move ends badly, and the stair step move higher, that's the more relaxed, paced move that you can take advantage of without worrying about losing your shirt, right? As soon as something starts to go parabolic, really, no matter what it is, it often knifes the other way just as violently, if not more so. So just be careful with those types of moves. Taking a quick look at the NASDAQ here, under just a little bit of pressure ahead of JOLTS, but we can see we made a new high on the day. S&P 500, don't see that same look, right? So that's just something to take into consideration. Would really like to see it make a new high as a part of a JOLTS reaction. If we get a cooler JOLTS, push up, make a new high, build some acceptance, consolidate, and then continue that push, that would tell me maybe we're going to make a positive trend, kind of reversing what we've seen over the last several trading days. So right now, we're really just chopping sideways. And instead of making new highs on the day, in the cash session, we've made new lows. And I'm going to bring on the financial juice squawk for the JOLTS announcement just so that they're able to read that off live as it comes through. We're looking at that in about 3 minutes. Again, 7.6 million is the level that the market is looking for. I'd be looking for 7.3 or less for a positive reaction. And I'd be looking for basically 7.9 or more for a negative reaction. We also have a 3-year note auction coming up at 1 p.m. Now let's just zoom out so we can look at the flow. There is still bullish flow coming into SPX options in excess of what we're seeing on the bearish side. So we've got that hot call level implied up there, warm call. Let me get the exact figures for those off of the Trader Aid Discord. This is part of the SPX options visualizer. That's pretty cool, is that we can look at those flow levels. Are updated minutely, and then we can zoom out and look at some of those bigger charts as well. So right now, if we're converting these to S&P 500 futures levels, that hot call is 5780.75. That warm call 5705.75, and then that hot put, boy, the hot put and the warm put quite a bit lower right now. 5430.75 and 5505.75. Now, as the day goes on, these levels are likely to tighten up a little bit. It's not too often you see the hot call and the hot put having such a large variance, a 350-point variance. So I do expect that to tighten up a little bit. But this does at least give you a sense that there is some confidence in the potential for upside. So we're getting closer to that data release, just about 1 minute away, 1 minute, 15 seconds. S&P cash down about 0.13%. NASDAQ up about 0.5%. VIX cash trading 27.74, down 0.43%. That elevated volatility could act as ammo for longs if we can get some good news, if we can get some flows of news and data that salve the nerves of investors. We are seeing increasing fears of recession as well, something I've been talking about since late February as a concern that the actions of this administration are increasing that risk. We do see the order book drying up, just like I said it would ahead of that data release. Data in 3 seconds. JOLTS coming in at 7.74 million. That's 7.74 million versus a forecast of 7.6. It's just high enough to spook the markets a little bit. We are seeing a negative reaction here. It's not within the threshold that I think is very negative, but it is within a threshold that may concern market participants a bit because it's coming in higher than expected, which again reduces the probabilities of that Fed intervention that the market wanted to see to some degree. Obviously, we'll look at short-term interest rates and we'll look at Fed Watch to see that reaction function, but the initial reaction of the market was a bit of a sell. Now seeing a bid coming into the S&P. We did have a bit of a stop run on that sell too. 268 contracts, nothing too big, but certainly got some of the folks out so that we could start to try to push the tape a bit higher, right? Sort of got to shake out some of the weaker hands. Also seeing a stop run on the other side, longs getting shaken out here, and now shorts getting shaken out. So you got the longs getting shaken out in that sell stop run. Now some of those shorts getting shaken out in that buy stop run. Really looking for a push above the point of control and making new highs to get more confidence that we can try to reverse some of the tape that we've seen in the last several trading days. Right now, just sort of making a sideways push. But again, let's check back in on call flow, and then I'm going to wrap this up. We do have the hot call coming in with more volume. We do see more confidence being expressed there, but it's relatively imbalanced with the puts. So the flow between puts and calls right now is kind of coming into a balance, which, if that remains the case, suggests a more choppy trading session than a trend. Okay, so watch that flow. And again, we update it minutely on our Discords. You're really able to get a sense as to how it may be impacting the market. Also, you can learn more about the SPX options visualizer by visiting traderade.com/SPX if you'd like to learn more. If you'd like to get a discount on Bookmap up to 40% off, it's a pretty chunky discount. Visit traderade.com/bookmap, scroll down to the special offers. And again, if you'd like to check out what we're doing at TraderAid, visit traderade.com and use the code Mayhem20 at checkout for up to 20% off. Thanks everyone for tuning in to this week's episode of Back to the Futures with me, Markets and Mayhem. Again, to recap, we got a hotter than expected jolt to 7.74 million versus 7.6 million, which was the expectation. And so far, the initial market reaction function has been a drop, a pop, and now we're dropping a bit again. So watch these key levels. Key one, if we push below that and we start to make a new low here, that does give us a chance to start making a downwardly trending day here, which would continue the pattern we've seen for some time. And someone certainly is looking for that with that 771 bid down here. They're looking to get a buy-in at a lower price. So again, thanks everyone for tuning in. I'll see you next week, Tuesday at 9 a.m. Eastern for the next episode of Back to the Futures. Hope you guys have a great trading week. Stay safe, size down, widen those stops, and be much more careful about trades. Remember, you can always sit on the sidelines if you're not comfortable with the tape. There's no shame in sitting in cash as well. Talk to you all soon.